As a realtor and an economist, I'm absolutely amazed at the lack of evidence to demonstrate there is actually a housing bubble in Canada. Therefore, I've put together some slides to show you the real facts about the situation, and you'll see that our Canadian housing market is rock solid. The concept of a housing bubble by economists started with the magazine The Economist and their rental rate versus selling price index in different countries. They gave Canada a very high index number, and that caused all the confusion we're looking at nowadays. But it was based on a lot of mistaken interpretations of the Canadian economy. First of all, we have rent control, so our rental rates are held down low, so we're naturally going to have a higher selling price index. Also, our rental market compared to, say, Britain, I mean, most of us are homeowners. We're not renters like they are in that country. Also, there was a housing shortfall compared to the amount of immigration we've had in a lot of our markets. So, therefore, demand exceeded supply. The inflation rate, everybody is talking about 1.1% in Canada. That is nonsense. In your households, you know that we're getting 15 to 20% increases in our bills for food and fuel and insurance. Also in Canada, we got much higher quality housing because we have vicious winters and we have basements and insulation and whatnot, so we have a lot more value in our housing. So the whole bubble thing is a false conclusion. The justifications people are giving for a housing bubble are totally specious. They talk about Vancouver prices, and there you've got everything is surrounded by mountains. There's very little land available. We had big immigration into Vancouver, and of course the prices are going to go up. That's a normal market condition. Similar to consumer debt, a lot of consumers switch from credit cards to lines of credit to take advantage of low interest rates, and you do not see any major debt defaults of any kind from the Canadian consumer. Similarly, they talk about long mortgages, 35, 40 years. They're less than 2% of the mortgages in Canada. So that's a specious argument. Similarly, they talk about our banks being overextended. Well, our banks were bailed out to the tune of about $120 billion. 70 of it came from CMHC, getting rid of the derivatives that the banks were carrying, as well as about a $30 billion bailout by the Canadian government. So our banks are not overextended right now, and in fact the bank executives are having nice bonuses and pay increases. So there's a lot of errors in interpreting our Canadian market data. If you look at the last 4 years and the monthly market performance in the GTA, you can't really see any indication of a bubble. I mean, the prices are in the normal seasonal patterns of increasing in the spring and then briefly in the fall, and unit sales are very close to matching each other every month. So we've really had a pretty stable, steady market for the past 4 years. And the price increases each year, they reflect the value of real estate and the increasing value from all the upgrades, because those are the homes that have been selling and creating the market. And of course, there's some real inflation in there, which we can expect under the current fiscal policies of the Canadian government. So there's no surprises here. Canada has one of the best performing GDP per capita results in the world. And because we're a northern country, our housing sector is actually a bigger portion of our economy than most other countries. If you look at this chart comparing the two, you'll see we've had a bit of house price catch up in 2010, but it's a normal housing sector performance, but the financial sectors were weak. And they also drew down the industrial sector as well, and we saw some difficulties in the prices in the commodities, which would affect us as well. So those underperforming areas of the economy account for the difference in them versus the housing sector. There are 7 major causes of a large price drop in houses, And none of these, as you can see from the probability here, are a likely occurrence in Canada. The US style derivatives default collapse, we've got a lot tighter banking rules in Canada, so that's not going to happen. I don't see the US monetary system collapsing and everybody buying into gold, which would cause a huge drop in house prices. We don't see US depression and their economy shrinking. We don't see that happening. Euro banking failure, nation failure, there's a reducing possibility of that as we go forward. We haven't seen hyperinflation take over, which it should have at the rate of the printing presses, but the economies of the world are absorbing all that currency that's being put into them. We don't see any likelihood of a major war, as there's a fairly good balance nowadays. And the biggest threat we really have is a media housing bubble hype happening, and people emotionally becoming fearful about holding on to their homes and losing their equity. There's very low probability that things that would cause prices to even decline in Canada of happening. Mortgage defaults, which are at 0.36%, below 1%, would have to escalate to 2 or 3%, and that isn't going to happen in Canada. Similarly, we need a major rise in unemployment, and in fact our economy is in great shape. There would have to be a rise in mortgage interest rates. Well, that's not going to happen because there's so much money being put into the systems nowadays. We need an economic depression. That's a shrinkage of the Canadian economy, and that isn't going to happen, especially with our new trade agreements that we're creating in Europe and in the Far East. And my only concern is the media is going to induce a panic selling over some issue. And I think that there's low risk of any price declines in the Canadian real estate market. Local markets also have factors that can cause them to go up and down in the short term. And if we take a look at the GTA, we got over 450 neighborhoods. They're all relatively independent. And like right now we've got situations where vendors overprice, then they panic and sell below the market value after a few price reductions. Yeah, that can happen. More sellers than buyers can occur once in a while in a neighborhood, and again, it's often just coincidental. Seasonal market characteristics, yeah, prices go down in the summer and they go down in the winter. And if we saw interest rates increase by more than 1%, we'd see fewer buyers in the marketplace, which could drive prices down. And of course, any local layoffs or local factories or things like that can cause price declines. Important to understand what drives prices up in some of the local markets. And multiple offers tend to do this, but again, it's a very small percentage of the markets in Toronto where you're consistently getting multiple offers. Similarly, area redevelopment, where you've got older homes being bulldozed and new ones going in, or people upgrading in an area, or even new housing being built nearby, will pull prices up. Sometimes we'll see that, yeah, gradually as the GTA expands, you'll see adjacent markets on the periphery taking advantage of these increases as people realize, hey, an extra 2-minute drive isn't going to hurt me, and so those homes go up. We also see sometimes industrial development within some of the smaller markets, and that creates more demand in that area. When we look at what causes no price growth, you'll see there's a high probability of that in the GTA because we're getting low market turnover in a lot of the neighborhoods, even below 3%. You've got a stable community. Incomes seem to be stable, and that means house prices stay flat. If your economy is not growing or declining, then prices stay flat as well. And of course, if there's no movement of people, the market's going to stay flat. So these conditions actually do apply in the GTA right now. So, what's my outlook going forward in the GTA? I think we're going to see a continuation that the vendors tend to overprice their new listings. We're going to see the banks still undervaluing properties when they do their mortgage qualifications. I think we're going to see a trend towards the 4 year mortgage instead of the 5 year mortgage because of future economic uncertainty. The condo market oversupply will be eaten up fairly quickly in Toronto, but at the moment, yeah, prices are going to be soft. We know that the buyers, because of global economic conditions, are very cautious and they're going to want good deals, so they'll be pressing to hold the prices down. Property upgrades will continue. People want a nice lifestyle, and we've got the money to afford it. Toronto's still a prime destination for people from all over the place. We've seen GTA land values rising, and some of the older homes that aren't fixed up, their values are declining, and that'll continue. We're seeing empty nesters are selling their main home and splitting their real estate investment into maybe a local home and maybe another one down south. And we're seeing retirees really aren't impressed with downtown Toronto anymore, and a lot of them are starting to look elsewhere. So overall, GTA has lots to offer.